Hey, good morning, everyone. Marty Mazzora here, September 19th, 2019, with your pre-market update. It's Thursday morning, the day after the big Fed meeting this month. And in front of you is the S&P 500 futures chart, the 1-minute chart. And I just thought I'd review with you, not that you didn't know already what was going on yesterday, but here's the move when the interest rate decision was announced, which was 1/4 point cut, and essentially news that there was really quite the unusual dissension. There's always some, but there are a number of members who really see no need for cuts going forward. There were folks who wanted zero cut yesterday, and folks like Fed Governor Bullard who wanted a 50 basis point cut. So Fed governors, very educated, very smart, experienced people, and when they look at the world, they see it through different colored glasses and have a different perspective. And that makes it quite interesting, give you a feel for how markets work and why at times there's so much volatility. Two people can look at the same set of data and have a real different view of the world and what is likely to happen next. And of course, that was very much on display in the markets, as it almost always is. So here we had the decision, looked like a disappointment for markets. Looks like the market wanted more dovishness. And then even during the press conference, we had more of that as well. That started right in here about 11:30. So the market bottomed while the Fed chairman was speaking. And then, good questions from the media. And when he started saying, yes, things look good, there are some issues, but make no mistake, if we need to, we can get very, very aggressive with monetary policy. And that's really what the market needed to hear. As I've been reporting, we've had pretty good data of late. Now, of course, that's been concentrated in the consumer space. Late last evening, I posted a blog where I articulated the fact that the consumer is doing the heavy lifting for the economy. And underneath that, the industrial space, the business sector, if you will, really is suffering. And that's what our data shows, and that's what yesterday's Duke University CEO survey confirmed as well. So that's not a great picture because it's usually the consumer that rolls over last. So we'll keep our eye on the market, we'll keep our eye on the data and so on, and continue to explain to you clients out there why we are maintaining a careful, pretty guarded approach to portfolio management these days, and why I continue to sound very cautious in our commentaries. So again, here's your 1-minute chart. We'll get off of this in a second. Overnight, came back down, about retraced about half of this gain here. And this morning, and not quite an hour before the open, you can see for whatever reason we're getting a nice rally in here in futures, trying to get back to what would ultimately be somewhat of a positive open this morning. As for the daily chart, as I've been illustrating, this ascending wedge pattern failed, as they almost always do, to the downside, although we really just have a sideways move. No big sell-off at this point, which frankly is still my base case. But as I said the other day, it makes a lot of sense to me that we come back up here, test what was support. We'll see if indeed it becomes resistance like it often does. Remember, though, I've been calling for the past few weeks to ultimately end up in here with what would be a marginal new high before ultimately the market rolls over and we have a real corrective phase. Again, that all is still my base case. I still give it, 50-50 odds, maybe even a little better that we get a boost up above here. There certainly is a lot of political incentive relative to the trade war. We've got good rhetoric lately. A deal with Japan supposedly is about to be signed. Congress seems to have a stomach to sign the new North American trade agreement. A group of Chinese negotiators are in Washington as I speak, setting the stage for the October meetings that are high-level trade meetings, and there's a lot of good talk around that. And then we have issues. China doesn't like the U.S.'s support for Hong Kong. Still have the Brexit fiasco playing itself out, and so forth. But frankly, when you consider what I just said about Japan and China and so forth, and how that's been impacting markets up till now, You would think that we'd be getting a really big rally right now into new all-time highs. I think it's a foregone conclusion that there will be some semblance of a deal struck before the election next year. Just for pure stock pricing purposes, I don't know in a very short-term basis that traders care about the quality or the aspects of the deal. They just care that we get a deal. Fundamentally speaking, of course, that's important. Fundamentally speaking, the tariffs to this point have done a real number on global supply chains, et cetera, and therefore a huge number on the global economy. Just ending escalation is not going to do the trick. This market looks heavy to me. The fundamentals look heavy. And a lot more than just some interim deal is going to have to happen there. And a real commitment not to continue to forward a protectionist stance with the rest of the world is going to be needed if we have any hope of a sustainable extension of this bull market and this expansion in the economy. In the meantime, as I said, the market looks kind of heavy. So I'm gonna finish up. I'm gonna show you a couple of longer term charts, illustrate that heaviness for you, and then an indicator of my own, and then a couple of data points, and let you get on with your day. Okay, so as for the long-term charts, this is your S&P 500 over the last 25 years, weekly charts. And as you can see, we had these bearish patterns forming, these ascending wedges, and again, on any time frame, whether we're talking daily, weekly, monthly, hourly, or on the 1-minute candles, these are patterns that we should respect. And you can see we had it forming very, very definitely before the tech bubble burst, before the real estate bubble burst, and clearly we have a similar pattern forming here. And our momentum indicators, the MACD and the RSI, you can see are rolling over quite noticeably here as this market continues to mount its way marginally now in very slow kind of rollover fashion into all-time highs. This is a very, I have to say, negative technical look. You can see you had it going into the real estate mortgage bubble bursting here, and again, you had it here in the tech bubble bursting. When we move further out on the monthly chart, you can see same pattern clearly, ascending wedge. You can see rolling over here from that last high. Hugely negative look here on the RSI. You can see similar looks, just a flattening out here going into the Great Recession. Clearly negative divergence on the RSI. Had them both here before the 20% 98 correction. Had them forming here in 2011. This 16% or so correction in here in 2015 and 16. Had them there, have them now. So the term that comes to mind is just heavy. The market is clearly looking to roll over. It looks like a very definite technical setup just in need of a fundamental catalyst to make it happen. These things could resolve higher. We could get more good news. We can have a scenario where we might get where we might become optimistic about profit growth going forward. It's just not what we have right now. Okay, so I mentioned a indicator of my own. Part of our financial market subindex, which is part of the PWA macro index, is a look at what we call the VIX curve, and that is the relationship between the spot VIX, that's the volatility index, tracks the cost of implied volatility on at-the-money S&P 500 index options. This is the spot VIX. This tells you where it's trading right now. This is the 1-month future, the yellow line, and the lines above that are the 2, 3, 4, 5, and 6-month future contracts. And what I've noticed in here as I track this is right before, last couple of years in particular, right before we got sell-offs, sometimes notable sell-offs or corrections, there was quite the gap between the spot VIX, meaning low volatility currently, and what was being discounted in the 1-month future and beyond. So what this was saying is that in the options market, traders were expecting low volatility for the moment, but a real spike in volatility 1 month and beyond. So I was circling that in here and showing again this gap between the spot and the 1 month just before these corrections. Here we are. Here's the August correction. Here's the May correction. Here's the huge correction. You can see that spike right before that 20% dip in the fourth quarter of last year. And you can see it, a couple weeks before the market peaked back here in January and then rolled over into about an 11% correction. One thing I noticed here just the last few days, though, is that in virtually every case leading up to it, what happened is the 1 month and the spot came down while the out months, held their own up there and discounted more volatility further out. And then suddenly we got a big spike in the 1 month while the spot VIX continued to be flat or come down. So you notice that you can see this gap beginning here between the 1 month and the 2 month and the rest of them. And then ultimately the 1 month caught up to the others while the spot VIX stayed down. So we had that happening in here during these bigger moves, if you will. And then look what we had here. You're just noticing this gap forming. And then just yesterday we had a big spike in the one month VIX future while we had the spot VIX remaining pretty flat. This, of course, to me, just kind of fits with my general narrative, and that is this market is getting heavy, and it's looking like the next noticeable move is likely to be lower, not higher. Doesn't mean that's how it's going to play out. That's just probabilities as we see them right now. And having said that, it still would not surprise me, even if it happens today, if we kind of melt up into new all-time highs in a kind of slow, stodgy, heavy way before we ultimately roll over. Not that we can't even get big spikes into that area, but what I mean is on the longer term charts, it would take a whole lot of good stuff to have us, sounding a bullish tone and doing more bullish things within client portfolios. And then lastly, just as the icing on the negative cake, if you will, take a look at earnings per share for the S&P 500. This is the aggregated earnings per share. That would be the green line. This is the monthly bar charts for the S&P 500 going back, 23 years or so. So we are looking very toppy in terms of earnings. In fact, the outlook isn't good for the next quarter, and that's going to start. And we're going to start reporting here in a couple of weeks. So here we are. You can see topping out. So here we were back in 2015 and 16, rolling over, and we had about a 16% correction there. Here, I drew this here because we did kind of top, although we really wasn't a big deal. But this was back 2011, 2012, and early part of this rolling over, we had a 21% correction. Of course, we rolled over big here during the Great Recession. We had a 57% bear market in stocks. Rolled over here as a tech bubble burst, and we had a 50% bear market in stocks. Flattened out here in 1998 during this 22% correction. Of course, there's probably other rectangles I can draw. Some of them ended up being benign for sure. But clearly, folks, we want to be on the lookout for earnings rolling over. Now, why would earnings roll over? Well, trade wars, disruption in supply chains, higher costs associated with that. It would make sense to me that the pressure on earnings under current macro conditions probably lower, not higher, particularly when you look at the heights that earnings have mounted here over the last couple of years. So really very suspect concerning picture in there. As for corporate profit margins, they are definitely at a peak. In fact, they've begun to roll over. Similar picture rolling over here, late 90s, 22% correction, then huge bear market. Huge bear market as margins rolled over, big correction. Margin rolled over, big correction. And just a real late cycle look at all-time high profit margins. Where can you go from here? And what tends to happen when profit margins roll over? And that's these shaded areas in there. Again, could we resolve higher? Could we stay sideways? Could this market meander higher? Absolutely, unequivocally, it could. We are open to all possibilities. But when we just line things up right now, we're not making a prediction that a big bear market is about to ensue. What we are saying is that the data, both technically and fundamentally, has us concerned right now. And of course, you clients out there, as your advisors, we can't see this data and continue to act as if everything's okay. So again, we're going to play it safe. We're going to allow the market to continue to melt higher with us just minimally participating in order to avoid a potential huge correction, big bear market in stocks, with the hedging strategy that we are actively employing on client portfolios. as I speak. I'll leave it there. Thank you, as always, for watching and listening. Much more to come. Bye-bye.